Silver's chart just flashed a death cross, and the automated sell programs are already loading. The 10-day EMA crossed below the 20-day EMA, price is sitting under the 50-day EMA at $84, and every algorithm watching that setup is eyeing tonight's close like a trigger. That is the chart. Now let me show you. What is underneath it? COMEX registered silver is sitting at 78,483,967 ounces as of this report, dated March 13, 2026, covering activity through March 12. That number dropped by over 1.5 million ounces in a 72-hour window, while the chart screams sell, the vault is draining. I am going to show you exactly why the death cross signal is not what it appears to be, why 78.5 million ounces of registered silver against 566 million ounces of open interest creates a structural fault line no EMA crossover can explain away, what the institutional playbook looks like when it uses technical fear to suppress a market sitting on a physical powder keg, and why tonight's close may be exactly the wrong moment to make an emotional decision. This channel exists because mainstream financial media covers the price. This channel covers what drives the price. CNBC will show you that chart. They will not show you that the paper-to-physical ratio just hit 7.18 claims for every registered ounce sitting in that vault, that gap between what you see on the screen and what is actually happening in the delivery system is exactly the territory this channel was built to map. If that is why you are here, like this video, just so I know you are paying attention. 7.18 to 1. That ratio is not background noise. That is the fuse. The actor at the center of this setup is the class of institutional participants running concentrated short positions in COMEX silver futures. These are the players who have the scale to move the paper price independent of the physical market and the documented history of using that scale deliberately. The playbook is not complicated once you see it. When sentiment in silver is neutral to slightly bearish, these players accumulate cheap put options and pile into short futures positions. Then they wait for a technical setup that retail traders have been trained to fear: a death cross, a break below a key moving average, a close under the 50-day. When that setup approaches, they dump spot exposure in concentrated bursts to push the print through the level that triggers the automated sell programs. The retail stop losses cascade. Price drops harder and faster than any fundamental data justifies. The institution covers shorts at the low books derivative profits and begins accumulating physical and futures longs at the exact price they engineered. That process is the price you see on your screen. It is not discovery. It is demolition followed by reconstruction at a lower cost basis. The CFTC has documented spoofing in precious metals markets in prior enforcement actions. No new CFTC spoofing findings are confirmed in the last 48 hours on this specific setup. What I can tell you is verified. The technical crossover arrived in the same window as accelerating registered inventory outflows. That alignment does not happen randomly at scale. They profit when you react emotionally. You profit when you read the vault. Here is what the CME Group Warehouse Report dated March 13, 2026 actually shows. Registered silver, the metal that is actually available and cleared for delivery against open futures contracts, stands at 78,483,967 ounces. The eligible category, which holds metal in approved vaults but not yet designated for delivery, sits at 260.77 million ounces. At Brinks specifically, the eligible category dropped by 1,765,459 ounces in the same reporting window. Brinks registered is listed at 11,651,846 ounces. SHBC Bank USA shows 3,377,178 ounces in registered. The total registered drain over the 72-hour window reached 1,524,813 ounces. That includes 740,429 ounces adjusted out of Brinks registered alone. Now take open interest. The latest weekly figure from Yicarts, derived from CME data, shows 113,326 contracts outstanding. Each contract represents 5,000 ounces. That gives you 566,630,000 ounces of paper obligation sitting against 78.95 million ounces of registered physical metal, 566,630,000 ounces of paper, 78.95 million ounces of physical. The ratio is 7.18 claims for every single registered ounce in that vault. Most people watching this have never seen those two numbers next to each other before. Here is what it means. In plain terms, there are 7 people in line for every 1 chair. When the music stops, 6 of them walk away with nothing. And what comes next is the part that tells you who engineered the line and where they are standing. Silver closed on March 13, 2026 at $81.34 per investing.com data. The 50-day EMA is sitting at $84, price is below it. The 10-day EMA is running at $81.38. The 20-day EMA is at $82.34. The 10-day is now below the 20-day. That is the bearish crossover the algorithms are flagging. For the chart watchers, strictly educational, not a signal, the textbook interpretation of this setup is continued downward pressure toward near-term support. That reading is not wrong on its own terms. The question is why the chart looks this way right now, and whether the technical picture reflects the underlying market or was constructed to produce a particular reaction. Alternative market commentary, and I want to be clear this is unconfirmed, circulating in social media and YouTube analysis circles, is pointing to sharp selling pressure during the Asian Open into the New York session that may be linked to a CME margin increase. That specific causal chain is not verified in mainstream reporting. What is verified is the price action itself and the timing against the registered drain. When physical inventory is leaving the vault at 1.5 million ounces in 72 hours, and the paper price is simultaneously being pushed below key moving average levels that retail traders have been trained to treat as exit signals, you are looking at 2 things happening in parallel that should not be happening in parallel. If the market is functioning naturally, the chart is real. The manipulation thesis says the chart was made to look exactly this way on purpose. Some market watchers are pointing to a significant price divergence between COMEX silver futures and Shanghai physical and futures markets. Alternative sources and recent market analyses indicate Shanghai physical equivalents have been trading in a range of $103 and above, while COMEX spot and futures sit in the $81 to $89 range in overlapping windows. That would put the divergence somewhere between $12 and $14 per ounce. I want to be direct about the sourcing on that number. This is coming from recent market analyses, not a live confirmed mainstream quote in the last 48 hours. The directional pattern that Shanghai has been running at a structural premium to COMEX for an extended period is supported across multiple sources. What the divergence tells you structurally is this: 2 markets pricing the same physical commodity at meaningfully different levels are not both right. Either COMEX is underpriced or Shanghai is overpriced. When physical delivery demand and vault drains in the West accompany a persistent Shanghai premium, the weight of evidence points in one direction. That is not a guarantee of price movement. It is a structural signal that the paper price at COMEX does not currently reflect the physical scarcity showing up in Eastern markets. The iShares Silver Trust (SLV), managed by BlackRock, is showing a net asset value of $75.80 per share as of March 13, 2026 per iShares official data. Physical silver holdings backing the trust derive from approximately 506.75 million ounces equivalent based on reported assets. No specific increase or decrease in SLV holdings is reported in the last few days. No significant silver-specific position changes from State Street, Vanguard, or central banks in Poland, India, or China are confirmed in this window. Central bank gold buying is well documented and ongoing. The equivalent silver accumulation data simply is not present in available public sources right now. That absence is worth noting. It does not mean accumulation is not happening. It means it is not reported yet. Let me show you what could slow this, because honesty matters more than cheerleading. The technical damage is real. A death cross with price below the 50-day EMA in a market that already ran hard over the last year is a genuine headwind. Momentum algorithms are not going to selectively ignore that setup because the physical market tells a different story. They trade the chart. The chart is bearish. That creates real downward pressure regardless of what the vault says. Second, the open interest figure being cited here comes from the most recent weekly Yikarts data as of early March 2026. It is a weekly figure, not a live real-time reading. If open interest has contracted meaningfully in the days since, the paper-to-physical ratio may be less extreme than the 7.18 calculation implies. Third, there are no new geopolitical triggers in the last 48 hours. No Federal Reserve statement, no BRICS announcement, no White House tariff action directly impacting metals in this window. The prior context from the Supreme Court tariff ruling in February and the subsequent safe haven buying is background context, not a live catalyst right now. The drain in registered silver is not a chart pattern. It is a physical event. Metal is leaving vaults. 1.5 million ounces do not adjust themselves out of a depository because a moving average crossed. Physical outflows reflect actual delivery demand, actual reclassification decisions, and actual stress in the inventory system. You cannot paper over that with a sell algorithm. The paper-to-physical ratio at 7.1. 8-to-1 means the delivery system is operating with 6 times more claims than confirmed supply. That does not resolve by waiting. It resolves when holders demand delivery and the registered pool cannot cover them. Algos can manipulate the chop. They cannot create silver that is not in the vault. The Shanghai premium, unconfirmed as the exact spread is, reflects physical demand in the world's largest silver-consuming market. That structural pull does not disappear because COMEX printed a bearish candlestick. Paper games have a ceiling. The vault drain has a floor. Check the CME Group silver_stocks.zl's file for the March 13, 2026 report date covering March 12 activity. The registered and eligible totals, the Brinks and SHBC breakdowns, and the depository level adjustments are all in that document. Check investing.com for the silver technical data, specifically the 10-day, 20-day, and 50-day EMA values as of the March 13 close. Pull the Yikart's open interest figure and note the weekly reporting lag. Check ishares.com for the SLV net asset value and holdings. The ones who actually verify sources realize this is not hype. The ones who do that homework understand what is building here without needing anyone to explain it to them after the fact. Physical silver holders. The fundamentals under your position have not changed. Registered inventory is draining, not growing. The paper-to-physical ratio is at 7.18-to-1. Your thesis is intact. Tonight's SEMA crossover does not change the vault. Hold position. This is not financial advice. Use your own brain. Futures traders, you are navigating a live bearish technical setup with real algorithmic selling pressure. If you are long near-term contracts, know your support levels and manage your risk accordingly. The structural case is bullish medium term. The paper game running right now is real near term. Those two things can both be true. Simultaneously, this is not financial advice. Use your own brain. ETF investors holding SLV or similar products. Your exposure tracks paper price, not physical delivery stress. You benefit if and when the paper-to-physical dislocation closes. The risk is that the paper price can stay compressed longer than the technical picture alone would suggest, because institutional actors with concentrated positions have demonstrated the capacity to extend these setups. This is not financial advice. Use your own brain. Everyone watching from the sidelines, if you have been waiting for a moment to understand why this market operates differently from what the chart tells you, this is it. Watch the registered silver number, watch it weekly. That number tells you more than any moving average. This is not financial advice. Use your own brain. Scenario 1. Bullish resolution. Registered silver continues draining. Delivery demand forces a paper price recalibration, and the Shanghai premium narrows as Western prices catch up to Eastern physical reality. Price reclaims the 50-day EMA at $84 and presses toward prior resistance levels. If this pattern holds, some analysts project a retest of the $90 range and above in the coming weeks. Probability, 40%. Scenario 2. Neutral consolidation. Price stabilizes in the $78 to $83 range while the market digests the technical damage. Registered inventory continues to drift lower but not at a pace that forces immediate delivery stress. The death cross fades into a range-bound chop without a decisive move in either direction for 2-2 for weeks. Probability, 35%. Scenario 3. Bearish extension. Tonight's close below key support levels triggers additional automated selling. Price breaks below $78 and tests the next structural support level. Open interest rolls before forcing physical delivery, and the paper price stays compressed for an extended period. Probability, 25%. Everything covered here is for educational purposes only. This is not financial advice. Use your own brain. Do your own research, always. Physical will win. The only question is when. Invest with logic, not hype. Use your own brain. Don't follow anyone blindly.